There's a family right now writing a six-figure check to the IRS, not because they messed up their taxes, but because their parents did everything right. They did everything right and so well, except the part at the end. They saved, they invested wisely, they built a portfolio, they built a business, and they built a plan, but they never realized their estate could become a tax time bomb. And unfortunately, their kids are the ones paying for it right now. So let's break this down. Because if your goal is to leave behind a legacy and not a liability, this planning really matters. My name is Chris McClure, and for over 30 years, I've helped families avoid the silent tax traps that show up in retirement and after retirement. A big part of what I do is I actually read the documents. I read wills and trusts and buy-sell agreements and IRAs and beneficiary forms, and I spot the disconnect before they become disasters. And the reason I mention that is that words matter. Words matter in all of these documents. And today we're going to talk about one of the most common issues I see, which is the inheritance tax time bomb. And here's how it works. Let's say you've got a $2.5 million IRA. When you pass that down to your kids, it doesn't stay tax deferred forever. Unfortunately, thanks to the Secure Act, they have just 10 years to empty that account. And unless you've planned for it, every dollar they pull out gets taxed as ordinary income. So if your kids are high earners, they could be paying 40% between federal and state income tax. On a $2.5 million IRA, it could easily shrink to $1.5 million after taxes. And I had a client, his name was Mike, whose father left him a $3 million IRA. Mike was a successful dentist in San Diego, and he was already earning $600,000 a year. And when that inheritance hit, it pushed his income over $1 million. That triggered extra Medicare taxes, and it cost him over $1.2 million in taxes over 10 years. And the kicker is he would have gladly given up a fraction of that if his dad had converted just even a part of it to a Roth. Mike said, "My dad thought he was doing the responsible thing, but no one actually told him this would happen." And you see, that's the story that I hear again and again. And it's not just about IRAs. Let's talk real estate. You see, if you leave your kids a house or a rental property, of course, that's what you want to do. But what if they disagree on what to do with it? I actually saw this happen with a family that I met after, unfortunately, the parents passed away. The kids inherited a $1.8 million vacation home in Lake Tahoe. One daughter wanted to keep it. One son wanted to sell and pay off debt. And they fought, right? They fought. The house sat empty for over a year. And eventually they sold it at a discount. They paid $180,000 in capital gains taxes. And what they had missed was they didn't correct the cost basis inside the trust. So they sold it for less and they paid extra taxes. And again, it was completely avoidable. And then there's the business. And this one's the biggest risk and the most dangerous in my opinion. I had one family I met where the father passed away with a 30% stake in a manufacturing company. And I started working with the children after the father passed away. On paper, it was worth about $6 million, but his buy-sale agreement hadn't been updated in over 12 years, unfortunately. His trust didn't match his corporate documents, and so the valuation method for the business was unclear. And in the estate tax process, the IRS challenged the value of the estate. So the kids had to come up with an extra $800,000 in taxes before they even received the proceeds from the buyout. And you can imagine the family was furious. The surviving partners were frustrated, and the estate planning attorney, well, that person had already retired. Now, we were able to help pick up the pieces, but all of these issues were completely unnecessary. And you can imagine all of these problems and all of these issues, they lead to stress. And that's the kind that really ruins families, unfortunately. And the point is, most people, they think about estate planning just of having a will or a trust. But it's really important to integrate your tax plan, integrate your legacy plan, and integrate your business plan so you don't pass on unintended chaos. So that could mean converting part of your IRA to a Roth in your 60s. It could mean updating your trust to clearly document cost basis and keep properties out of probate. It also might mean aligning your business agreements and estate documents so your buy-sell doesn't conflict with your family's estate plan. Or maybe it means using beneficiary designations strategically, not just automatically. You see, all this planning that I'm talking about, it doesn't require exotic tax shelters or offshore strategies. It just takes coordination and intention and someone looking at the entire picture, not just your portfolio. So if you want help making sure your kids don't inherit a tax time bomb, please feel free to schedule a quick call. Either way, you're going to get real personalized insight based on your goals, based on your timeline, and most importantly, based on your numbers. I really love making these videos, and I'd be happy to chat with you. And if not, no problem. Thanks for watching, and I'll see you on the next one.